Welcome to the MarketEdge Tech Talk with Will Paule and special guest David Blake. We're going to review the market conditions of the past week as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tech Talk for Tuesday, April 26th, 2022. I'm your host, Will Paule, and I'm here with my co-host, David Blake. How are you doing today, David?
Doing good, Will. Thanks.
All right, let's start off with a look at what the market's been doing this past week with a look at the market letter.
Okay. We had a rough week last week, and that seems to be carrying over this week as it came in last Friday, and the market just gapped down after the Fed Chair Jerome Powell in a meeting with the IMF at their global debate talked about future rate hikes. He mentioned that he believed a half point was on the table there for the May 7th and 8th meeting, and probably another one in June, which again is the ascent of these hikes is what the market never can adjust to. They can handle gradual rate hikes, but not big moves like this, and that pretty much sent people selling stocks when they came in here on Friday. We were able to kind of to shake off some rising rates early in the week, and also some decent earnings helped hold stocks up a little bit. But on Wednesday, the market struggled with Netflix earnings. They came in, we were looking for 2.5 million new subscribers. They actually had a loss of 200,000, which kind of caught analysts by surprise, and that kind of took down the whole streaming media, the industry group type. We had Walt Disney was down big. We also had Metaverse was down big. Alphabet was down big. Alphabet has the YouTube stuff. Walt Disney has the ESPN and all of that. And then, of course, yesterday we saw that CNN Plus is giving up their streaming media. So, everybody was jumping into it. Now everybody's kind of jumping out of it, and we're going to end up probably with just a couple players, in that thing. Now, we did have some good, strong earnings from Tesla. Dow Chemical had a good report. American Airlines, United Airlines came out with some strong reports saying they're seeing, a little kick in the in business travel, and there also just a lot of pent up demand for travel stocks. So, and I said the transportation index actually ticked up, had a higher, was up a little bit last week, which showed some positive divergence, but we didn't get the positive divergence from the Russell 2000. It was actually down 3.2%. The only index that beat that was NASDAQ 100 and the NASDAQ. They were both down almost 4%. And I believe semiconductors were down, I think semiconductors might have been down 5 or 6% also last week. They've had a couple of really rough weeks. Anyway, so we saw on Friday, we saw the 10-year yield actually jump up to 2.95 Thursday afternoon, and then on Friday it actually settled at 2.86 or 2.869. We are seeing a little bit of a pullback in yields today. It doesn't matter to the market about that, but we'll talk about why we're seeing that here in a little bit. Now, again, what we saw last week, defensive sectors outperformed. We had REITs and consumer staples were actually positive last week. They just had small gains. Well, communication services, which includes Netflix and Metaverse, they were just hammered. It was down 7.76% last week alone. That was the worst performing sector. And then we saw energy slumping a little bit. It was down 4.57%, and that's coming to why we're also starting to see the yields tick lower in here just a little bit. That's basically because you had the shutdowns in China going up right now. They shut down Shanghai. Now they're shutting down Beijing. Yesterday, the China's Shanghai index was down 5.13% on growth concerns. If you're shutting down your economy, you're going to have some support numbers to come out of that. It also is going to make less demand for oil, which in a way is kind of good because that will help bring the price of oil down a little bit because we're still using a lot of it over here. So a lot of bad things going on out there that are between hiking rates into an economy that looks like it's probably slowing down here, and that's not good for stocks in general. We ended the week last week at the lows of the period. I mentioned that the only good thing was that last Friday we did actually hold above the February and March lows. That may not be the case for long. So the technical condition of the market deteriorated again. All the different technical indicators are showing the trend is negative, momentum is negative, and starting to slowing even more. We're trading below all the key moving average support levels which are now resistance levels. Doing that confirms the downtrend. We had the Philadelphia Semiconductor Index, NASDAQ, and Russell 2000 ended Friday all in a bear market. So you're just getting more and more of these. Several sectors are now in there. We talked a couple weeks ago how defensive sectors like REITs and consumer staples and utilities are outperforming the broader market in a position where yields are going up, and that doesn't happen normally. Normally, when the rates start to tick up a little bit, people say, "Well, why should I buy get yields from utilities or consumer staples or something like that with risk when I can go out and get treasuries that pay the same thing?" So that was telling you that the investors are rotating into safety, not just for yields. They're just going for the safe, any type of safe investment. And some of these funds have to have stock positions in them. They can't just go all cash. So if they have to have something, it's going to be the defensive sectors. You're not going to see the utilities and stuff go down 50, 60% like you're watching on the tech stocks. So that's why you're seeing this conflicting move in different indexes, and I imagine we'll see that again today. In fact, let me while we're sitting here, let me check just to see what sectors are outperforming today. Finally, we're also seeing as far as the underlying breadth in the market, we're still seeing deterioration in the AD lines. It lost a lot of units. I think the NASDAQ lost something like 4,000 or 5,000 units last week. The NASDAQ lost 4,500 units on the AD line. The NYSE lost almost 3,000 units. New 52-week lows continue to outnumber the new 52-week highs by a wide margin. Investor sentiment is also overly bearish and getting more bearish, which normally I would say that could indicate that we're nearing a bottom, but you still have a little bit to go. We had the percentage of bullish investment advisors fell to 32.1%. That's the lowest number since this past mid-March. But we did see a small uptick in hedge funds in their exposure to equities last week. That they went up to 74% from 63% the week before. I think that's probably we had that little bit of a bounce. We came down, tested little some support levels, but then hold. So we'll probably see that go down a little bit further. And also we think it was the retail investors. We saw just a small uptick in that last week too, and I mean very small. Normally the retail investor is going to be about 38% bullish. We're down now at around 18-19%, so about half of what you normally would see from retail investors. Just to wrap things up on that, we had last week Goldman Sachs chief economist warned that there was about a 35% chance of a recession in the U.S. due to because of the soaring inflation and the war in Ukraine and the Federal Reserve hiking rates. That's not good. They also trimmed their growth expectations for the economy to 1.75%. Below 2% means you're pretty much almost probably going into a recession. We may be in a recession right now. It's hard to tell. We also had some grumblings last week after Thursday that maybe the Federal Reserve would hike 0.75 of a point in June. If they do that, you're probably going to see even more of a drop on the market. If we can hold around here a half, we still could see a little bit of a drop. But a 0.75 hike, and then if they continue to say that another half point would be in the cards, and you'll probably see more of a sell-off. So things aren't looking real good right now. We've adjusted our CTI. You may have noticed that the CTI is a market forecasting tool. Has been in use actively since 1992, I believe, and it's done well. It's outperformed the S&P 500 by almost 2 to 1 over 30 years. And it's kind of a thing that you're always adjusting because you don't know when new lows are going to be put in. That would have changed. It would have changed the counts to the different cycles. And I actually was adjusting some numbers this morning, and most likely a little bit late, but we're just going to go to a sell on this. It doesn't look like this current cycle until we're probably going to end this sell-off until probably the end of May, last week of May, maybe first week of June. We'll have to see around that time period. So I think we've got a little bit more damage to go, which probably means that maybe we go into a bear market with the Dow and the S&P 500 also. So things aren't looking real good. It's not a time to be jumping in trying to be a hero by any means. I'm trying to let this when things like this go around, and most people haven't seen the bear market. You just kind of you kind of let things adjust, and then you at this stage, if you got something that you just want to get out of, maybe if you see a rip in it, maybe you can take some profits. You can buy some puts on some of its positions, or still have a nice profit on if you have that. You can be selling covered calls. A lot of different things you can do, but in general, you're probably your account size is going to be going down over the next few weeks, and that's just part of the game here that being in the stock market presents to you.
All right. So you've been saying that you think the major averages could be range bound leading up to the May FOMC meeting. But with the sell-off over the last few days, do you think that's still the case?
No, well, I'm changing it today. Let's go to the charting package a little bit. Go ahead and pull up the NASDAQ first. Okay. If you draw a line going down here to the lows on the NASDAQ, or going where it marks the the February and March lows, you can see we got close to that on Friday and yesterday. Well, today, as we speak, let me see, the NASDAQ is down another almost 400 points. So we're looking at, 387 points is down here at 12.6. So today we actually are taking out that bottom. I was whether hope or whatever, I thought that perhaps maybe we could see these indexes hold that low. The actual low in here, as we speak right now, the NASDAQ is right at it. It's like basically 12,600 was where the March bottom was. Looks like, or 12,580, somewhere around there. And I right at this moment, as we're speaking, it's 12,617. So possibly it holds, but I don't think it's going to. You have earnings tonight from Microsoft, Google coming out. You have Facebook later on in the week, and I don't care whether they present good earnings or not. You're probably going to see a pullback in them anyway. And if you have a 5 or 6 point or 10 point drop in something like a Microsoft, or a 50 point drop in Google or Alphabet or Metaverse, something like that, it's going to over exaggerate the downside. And in this case, we're right at the low as we speak right now in the S&P 500. So go ahead and go to the to the NASDAQ. Go ahead and go to the S&P 500 a minute. Okay, now this one, we're still range bound in this. We got down, I said in the letter a couple of weeks ago, you can draw that across there. I said the downside target, the range would be 4,200, and that's basically where we got. Today we hit exactly, yesterday we hit 4,200 before we bounced. Today we hit 4,200 or 4,217. To take out the lows, 4150 was the low in February, and then in March twice we got down to around 4150. I think the February low looks like it was almost 41, about 41.10, something like that. So it's still in the range. But if the Nasdaq breaks through it, I don't think it's going to be hard for these indexes to stay in that trading range. So far, so good as of today. And like I said, if that is the case, consider it lucky. But if you see these things take out those bottoms, we don't need to look at the Dow Jones. It's a little bit, it's still in the range also. But again, if we see the Nasdaq crack through that range, that's probably a good indication that the others will. The Dow and the S&P 500 will go into a bear market at that 20%. Russell 2000, same thing. It came down to 187.50 on the IWM ATF. We're 189.66, so it's within 15, 20 points of making a new high. I mean, a new low. Philadelphia Semiconductor, I think, already took out those lows, if I'm not mistaken. Let's see here. Yeah, it took them out like 3 on Friday. It took out the yearly lows. So at this stage, I wouldn't be a buyer of anything. I would maybe look at some of these things like Alphabet and Microsoft. Some of those. Maybe you go back on the charts. If it's go back 1 year and see where some of the support levels are. When it came down and bounced off of those levels and then started going back up again. But there's no hurry to get in this stuff. Again, we've got a couple more. The Fed still hasn't even raised the rates, the half point or whatever it's going to do in the first week of May. So we have that ahead of us. We have another FOMC meeting in June. None of that is good right now for the market for buying equities. And another thing we're starting to see as on slowing growth concerns, you're starting to see the 10-year come down a little bit, which is we're probably going to see another rate inversion here soon as the 2-year spikes up, and then they start figuring in slower growth going out a couple of years to maybe probably a recession, and you'll see that the 10-year come down. We may have another rate inversion here. Over the near term. So keep an eye on that. But at this stage, I think we probably have another 2 or 3 weeks or 4 weeks left at least of some pretty rough sledding here. And with that, this may not be. I don't know. You never know when the bottom's in. But at this stage, with we don't see any type of positive divergence, which would hint that stocks could be getting ready to started seeing some accumulation at the bottom. We'll talk about that on some of these different tech talks, perhaps, because a lot of times we'll start to see a little bit of reversal in the AD lines where, even though you have a down day, you're getting more stocks advancing and declining, that type of thing, and you start seeing the number of new 52-week lows begin to contract. Those are signs of positive divergence that means that the institutions may be thinking that they want to start getting involved in the market at this time, but we're not seeing that quite yet. So with that, just be patient, and these things eventually turn around, and we'll see stocks go a little bit higher.
All right. Well, that's all we have for you this week. Remember, if you have a question you'd like answered in the next Tuesday Tech Talk, email it into support@marketedge.com or ask one of our live chat representatives to pass your question along to us for the next Tuesday Tech Talk. Thank you for tuning in, and we'll see you next week.